Hey everyone, and welcome. Today, we're going to talk about something that's kind of invisible, but actually shapes your entire crypto experience. We're talking about regulation, compliance, and yes, taxes. This is the stuff that works behind the scenes, influencing everything you do in crypto, so let's get right into it.
So here's a question for you. What's that one thing, that invisible force that can send prices on a wild roller coaster overnight, even when the underlying tech hasn't changed at all?
Yep, you guessed it, it's regulation. The simplest way to think about it is like this. Regulation controls the pipes. It controls the on-ramps and the off-ramps where real-world money flows into and out of the crypto ecosystem. And that flow, that's what gives everything liquidity and value.
Okay, so first up, let's get into the why. Why do these rules have so much sway over the market? Well, it all boils down to how easily money can get in and get out.
Just think about the most basic thing you do, buying crypto. You send money from your bank, it goes through some kind of payment processor, and it lands at a licensed exchange. Every single step of that journey is wrapped up in regulations that decide who's allowed to operate and how they can do it. Regulation is basically the gatekeeper of this whole process.
And this is where you see the huge difference it makes. It's really two sides of the same coin. When you have clear, stable rules, big players, the institutions, feel safe enough to jump in. That brings more money, more confidence, and things generally calm down a bit. But on the other hand, when rules are unclear or they suddenly get super tight, that money can just vanish. It can move offshore, risks go through the roof, and you get that crazy volatility that crypto's famous for.
Okay, I know regulation sounds like this big, scary, complicated thing, but we can actually make it super simple. No matter where you are in the world, pretty much every single crypto rule fits neatly into one of just 5 buckets.
So, let's run through them. First up, you've got market access. Basically, who gets a license to run an exchange. Then there's consumer protection, which is all about keeping your funds safe. After that is market integrity, rules to stop things like wash trading. Fourth, and this is a big one, is financial crime compliance. This is all your KYC and anti-money laundering stuff. And finally, product permissions. What are you even allowed to do? Can you use leverage? Can you stake? A single headline about a change in any one of these buckets can send ripples across the entire market.
So that's the high-level stuff. Let's bring it right down to earth. You know when you sign up for an exchange and they ask for your driver's license? Or when they ask where you're sending your funds? Well, that all comes down to compliance.
First things first, KYC. Know your customer. And here's the key thing to get. This is not the exchange being nosy. It is a legal requirement for them, often based on global standards, that's all about preventing fraud and fighting financial crime. They have to do it.
And KYC kind of leads into this next thing, the travel rule. It sounds complicated, but all it really means is that when you go to withdraw crypto, the exchange might have to ask who it's going to. The goal is just to make crypto transfers as transparent as, say, a regular old bank wire.
So what about when your account gets frozen? It's a scary moment, right? But listen, it's almost never personal. It's usually just an automated system that's flagged something a little out of the ordinary, like a huge deposit out of nowhere, you logging in from a different country, or maybe your ID just expired. The exchange is just following its own compliance rules to manage risk.
All right, deep breath. Let's talk about the one thing nobody wants to talk about. Taxes. I know, the rules are different everywhere, but the big ideas behind them, they're actually pretty much the same all over the world. So let's break it down.
So almost everywhere, tax stuff breaks down into 2 main types. On one side, you have disposal events. Think of this as getting rid of your crypto, selling it for cash, swapping it for another crypto, or even buying a coffee with it. That's where you might have a capital gain or loss. And on the other side, you've got income-like events. This is when you earn new crypto, like from staking or mining rewards. That's usually taxed as income right when you get it. And please remember this one key thing that catches so many people out. Swapping one crypto for another? Yeah, that's almost always a taxable event.
Now, the thing that causes 99% of the headaches with crypto taxes is this term right here, cost basis. All it is the price you originally paid for your crypto. That's it. When you sell, your profit is just the sale price minus that original cost. Sounds simple, right? The tough part is actually keeping track of it for every single transaction.
And if you're diving into the world of DeFi and NFTs, things get, well, a whole lot more tangled. A single transaction, like adding liquidity to a pool, might actually be 2 or 3 different taxable events all bundled into one. This is exactly why you can't just wing it when it comes to your records. It's just not going to work.
Okay, so after all that, you're probably thinking, this is a nightmare.
But don't worry. What can you actually do about it? This last part is all about action. It's your simple, straightforward playbook for staying safe.
Look, if there's only one thing you take away from this whole thing, let it be this quote. If you don't track it now, you'll end up reconstructing it later, painfully. And trust me, the pain of trying to piece together years of transaction history is something you really, really want to avoid. So here it is, your playbook. It's actually super simple. Step 1. Get in the habit of exporting your transaction histories from every exchange you use. Step 2. Just keep a simple list of all your wallet addresses. Step 3. For every single transaction, jot down the basics, the time, the amount, the fees. And finally, Step 4. Just add a quick note to yourself explaining what you did. Bought ETH, staked SOL, bridged to Arbitrum. That's it. This one simple habit will literally save you days of headaches down the line.
And look, this isn't something you can just ignore and hope it goes away. The whole world is moving towards more transparency, not less. There are these huge global frameworks being built, like the OECD's CARF, which are all about getting countries to automatically share crypto tax info. The world is getting smaller, and good records are becoming non-negotiable.
Now, of course, we have to put up the big disclaimer. This is all for educational purposes. It is not legal advice, it's not tax advice, and it's not financial advice. The rules change all the time, and they're different everywhere, so you absolutely have to check the rules for where you live, or even better, talk to a professional.
So, I'll just leave you with this final thought. In a world where the rules are constantly changing, where global reporting is becoming the new normal, what's your best line of defense? Is it some fancy lawyer or complex strategy, or is it something much simpler, a clean, accurate record of everything you've done? Yeah, I think you know the answer.